Good afternoon. My name is Amélie Ferron-Craig, press officer at the Bank of Canada, and I will be moderating this press conference. Governor Macklem will be pleased to take questions for about 20 minutes. Before asking your question, please state your name and affiliation. We are webcasting this press conference, so please use the wireless microphone, which my colleague will be bringing to you if you raise your hand. And we have a lot of people in the room today, and we also have a lot of journalists participating by teleconference. So we'll do one question in the room, and then we'll turn to the call to try to make sure that everyone gets a question. And the governor will be happy to answer questions in both official languages. Alors, on va commencer par les journalistes qui sont dans la salle aujourd'hui, avant de passer aux journalistes qui participent par téléconférence. Avant de poser une question, prière de vous identifier. Je vous demanderai également d'utiliser le micro sans fil. Libre à vous de poser vos questions dans la langue officielle de votre choix. So, we'll start taking questions.
Hi, my name is Robert Tuttle from Bloomberg News. My question is, given your institution's relationship with Canada's finance minister, is it appropriate for Freeland to be characterizing your decision to hold rates steady on Wednesday as a, quote, welcome relief?
Look, the Deputy Prime Minister and other elected officials around the country, they're hearing from their constituents. And I think, they're hearing what we're hearing. We're hearing directly from Canadians that high inflation is hurting them, and they're hearing that the increases in our policy rates certainly squeezing some Canadians and making life even more difficult. I think you've seen elected officials around the country express that. Look, unfortunately, there is no pain-free way to restore price stability. The destination is worth it. We don't want to make it any more difficult than it has to be. But we do require higher interest rates to lower inflation. If we hadn't raised interest rates, inflation would be a much bigger problem. Monetary policy is working. As I highlighted in my remarks, we're not there yet, but the target's in sight. We need to stay the course. The Bank of Canada is set up to be operationally independent. There are good reasons for that. And that operational independence, that independence, it's more important when the decisions are difficult. The decisions are difficult. I am confident that the Bank of Canada remains independent. We have a clear mandate. Canadians expect us to control inflation, and that's what we're doing.
Hi, Sean Polzer, Western Standard. In your remarks in the room, you said the impact of the carbon tax was about, 0.15% on inflation. I'm just wondering how you arrive at that number and whether that gets factored in through not just energy costs, but all the inputs, because obviously there's a lot of inputs in agriculture and manufacturing.
It's a good question, and we can take this offline if you want. But yes, that is the direct impact on the components that are most directly affected. It does not include any second round effects.
And is the economy going to absorb it, given that the carbon tax is going to essentially triple between now and 2030?
So the carbon tax, the announcements have it going up. As I said, our estimate is that increases inflation each year by 1.15%. So inflation's measured over 12 months. So yes, each year it's 0.15, but that's a relatively small effect on year-over-year inflation.
Anis Hidari, CBC. You have mentioned that so far you've been able to cool demand. We've been able to cool demand in the economy without unemployment spiking. We've got jobs numbers coming out tomorrow. Are you expecting that to continue? What are you hoping to see out of the jobs numbers tomorrow?
Well, look, I'm not gonna hazard a forecast on the job number tomorrow, but I will say what we're expecting to see. We have what have we seen? We have seen a gradual easing in the labor market. And you can see that in a number of statistics. The vacancy rate has come down. It's taken some time, but it's now come down quite a bit. The employment growth, it's still been certainly positive. Employment's still been growing, but it's been growing less than population growth. So what that suggests is that the sort of supply of workers is growing more than the demand for workers. So supply is catching up with demand, and those pressures are easing. So we expect to see continuation of that trend. We expect to see, for a period, employment growth continue below population growth. Certainly, we've seen easing in the labor market, but there are still labor shortages. Labor market is still somewhat tight.
Dylan Short with allsaskatchewan.com. In the past, we've seen when there's been pauses that there's been, mini housing booms. Is that something that you're worried about this month, or is that something that was taken into consideration, what's happened after previous pauses?
Look, the housing market is an important part of the economy. We have one instrument, our policy interest rate, and we have one objective, and that's price stability. And we have to look at the whole economy. So what's going on in the housing sector certainly factors in to our decisions, but it factors in along with a lot of other things. What have we seen in the housing market over the last number of years? When interest rates were at emergency low levels, housing prices, demand for housing soared. Housing prices went up very sharply. They were up on a national basis about 50% over 2 years. With the forceful increase in our policy rate, housing prices actually came down 16%. They've since bounced back up a little bit, have been relatively stable. At the same, that if that was the only thing that happened, that would have improved housing affordability. But of course, higher mortgage costs higher interest rates make the carrying cost of mortgages higher. So that's hurting housing affordability. But I guess what I'd say is, look, we had housing affordability issues when interest rates were very low. We've now raised interest rates. We still have serious housing affordability issues. I don't think you're going to solve this problem with interest rates. The fundamental issue is, for a number of years, demand for housing has been running ahead of supply. And the one thing I will say, housing policy is policy of elected governments, not the Bank of Canada. But we are pleased to see that governments at all levels are really starting to get together, to put their heads together and figure out how are we going to cut through some of the barriers to growing supply.
Hi, Jason Markisoff from CBC Calgary. I want to thank you for the 0.15% figure. It's not something I'd heard, and it definitely contributes to public discourse on this. Is there a comparable figure for the impact on inflation of government's spending?
That's government spending, of course, covers all sorts of things. And government you have to look at, some parts of government spending largely affect demand, and obviously, everything else equal, that contributes to inflationary pressures. Other parts of government spending have important effects on supply. So, for example, subsidized daycare increases labor market participation, particularly of women with young children. That adds to supply in the labor force. On the other hand, other policies add to demand. So I can't give you a nice number because government spending is not one policy. It's many, many policies. What I can say is that if you look at overall government spending in the economy over the last number of quarters, it's been averaging around 2%. So government spending, and that's all levels of government, federal, provincial. What that means is that government spending is contributing to growth. It is adding to demand in the economy. We take the government's plans into consideration. They are built into our forecast. We take the government's budgets, their fiscal plans, we build those into our projection. And in the projection we published in July, we have inflation coming gradually back to our 2% target by 2025. Now, if governments were to increase the rate of growth of spending, that would make it more difficult to get inflation back to target.
Bonjour, Nassim Aoué à Radio-Canada. J'ai une question par rapport à l'impact de l'augmentation du taux directeur sur les Albertains, surtout que la majorité de leur endettement ici dans la province, c'est un endettement de carte de crédit où c'est un taux fixe, alors que le prêt hypothécaire touche le reste du pays. Est-ce qu'il y a une différence? Est-ce que vous pouvez expliquer ce qui se passe en Alberta, l'impact de ce taux en Alberta, considérant que c'est surtout un endettement de carte de crédit à taux fixe?
Il y a toujours des différences entre des différentes provinces. Les marchés de logement, par exemple, peuvent être dans une situation un peu différente, une ville à l'autre. L'endettement des citoyens peut être un peu différent. Mais Alberta regarde similaire à la plupart du pays. On voit demande pour logement est très fort ici. C'était un peu moins fort ici que d'autres provinces, comme surtout les grandes villes, Montréal, Toronto, Vancouver. Calgary était un peu moins, les hausses les prix de maisons étaient un peu moins ici. Mais maintenant, on commence à voir plus de demandes ici. Si on regarde des autres aspects, ils sont similaires. On sait que l'endettement des Canadiens est plus élevé et ça suggère que si c'était la seule chose, que les effets de l'augmentation de notre directeur sera plus fort parce qu'ils ont plus de dettes pour payer l'intérêt. Mais à l'autre côté, ici à Alberta, comme le reste du Canada, l'épargne pendant la pandémie était plus haut parce qu'on ne peut pas aller au restaurant, on ne peut pas aller en vacances. Et donc, les dépôts dans les banques sont plus élevés. Et probablement, donc, les deux effets contrebalancent d'un certain extent. Donc, est-ce que l'effet du politique monétaire est plus fort ou plus faible? À ce point-ci, c'est difficile à dire, mais c'est à peu près le moyen d'histoire. Okay, let's see if I can remember it all. So the question was about are there particular differences in the indebtedness of Albertans or the financial health of Albertans relative that are different from the rest of the country? And the short version of the answer is, look, there are always some differences between provinces. Certainly, housing markets tend to be somewhat local. The Calgary market you did not see house prices go up as much in Alberta, certainly big cities in Alberta, Calgary, Edmonton, as you did in Montreal, Toronto, Vancouver, for example. However, you're starting to see those things are starting to equalize. You're seeing more strength here in housing. So, the basic message is Alberta looks pretty similar to the rest of the country. And the other thing I mentioned is that, for a number of years now, household indebtedness has been rising in Canada. Other things equal, you would expect that higher interest rates would have more traction if households are more indebted because they've got to pay more interest. However, on the other side of that, households built up what economists at least call excess savings during the pandemic. Basically forced savings. We couldn't take a vacation. We couldn't go to a restaurant, so we spent less money, and so households have extra deposits, more deposits than usual in their bank accounts. That may be buffering that. So the lags of the effects of monetary policy. we'll have to see in the fullness of time, but so far they look about normal, look about average of history.
Hi there, Jordan Canigan with CTV News. Thanks for taking my question. Some economists have suggested that Canada is in a recession or is on the verge of heading into one. Do you agree with that assessment? Why or why not?
I don't think we're in a recession. You look at the unemployment rate; it's 5.5%. Unemployment, the labor market remains healthy. By sort of any normal measure of GDP growth. I mean, GDP growth was very slightly negative in the second quarter, minus 0.2 annualized, essentially zero. What are we? I think what they're referring to is more about where we're headed, and of course, nobody can know the future for certain. What are we expecting? We are expecting low positive growth. So, you take the average of the last 3 quarters, growth's been a little less than 1%, and we'll put out a new forecast in late October, but, I expect the recent trend, it'll be something around the recent trend for the next few quarters before it picks up once again. Is that a recession? No, that's not a recession. But I will say that if you're forecasting very small positives, you can't rule out that you could get a couple of small negatives. Some people might call that a technical recession. I don't think, a couple of very small negatives are what most people think of when they think of a recession. It's not a big contraction in output. It's not a large rise in unemployment.
Thank you. So we will now be going to questions on the phone line. I would just like to remind people on the call to mute their line if they're not asking a question. So we will start by Najoud Al-Maliz of Canadian Press, then we'll go over to Paul Vieira of Wall Street Journal, and Steve Shearer of Reuters. So you can go ahead, Najoud.
Hi, Governor. Given recent remarks by Minister Freeland and the suggestion from the NDP that the minister could ask the Bank of Canada to stop raising interest rates, I want to clarify what's at stake here. If the finance minister issued a directive regarding rates, would you decide to carry it out or resign?
Look, I think this is a pretty hypothetical scenario. I think the Deputy Prime Minister has been very clear that she fully respects the independence of the Bank of Canada.
Thank you. We will now go to Paul Vieira of Wall Street Journal.
Mr. Macklem, in your remarks, you talked about interest rates might be at sufficiently restrictive levels. Is this a signal that the Bank of Canada is prepared to sit tight and that no further rate increases might be necessary?
Paul, I hope we've been pretty clear. We're going to take this one decision at a time, and we're going to take those decisions based on the best available information and analysis at that time. Yesterday, we kept our policy rate at 5%, and we agreed that we were prepared to raise interest rates further if needed. So your next question is probably, well, what is if needed? I mean, what are we seeing? I mean, what we're seeing is monetary policy is working. Inflation has come down significantly. And the economy has entered a period of weaker growth that's needed to rebalance demand and supply and relieve price pressures. But look, inflation is still too high, and we are conscious that the downward momentum in inflation has slowed. And as we emphasized in our policy statement yesterday, we are concerned about the persistence of inflationary pressures. So we are going to be carefully watching and assessing a variety of inflation indicators. I spent quite a bit of time today outlining some of the most important ones. And look, if we come to the conclusion that we haven't done enough, we're prepared to do more, but we don't want to do more than is necessary.
Thank you. We'll go to Steve Shearer of Reuters.
Governor, Canadian productivity has fallen in 11 out of the last 12 quarters. Has this made it harder for you to bring inflation down? And, you know, in terms of Canada's serious economic problems, would you rank it as one of the top ones?
Short answer is yes. Weak productivity growth has been a serial problem in Canada. And as I just responded to a question a few minutes ago, you know, there are some structural reasons for that. Canada has some structural advantages. It also has some structural disadvantages. We do have some structural disadvantages on the productivity side, but there are certainly things that we could be doing more to improve our productivity. You know, I'll be frank. You know, coming out of COVID, we thought we would see more of an uptick in productivity. Just, you know, the fact that COVID protocols, you know, we didn't have to deal with protocols. Many people are back in the office. We're working in a much more normal format. Supply chain issues have significantly improved, so that, you know, production isn't being disrupted. So far we have not seen that, and that is a concern. As you mentioned, productivity growth has been declining, and certainly our own forecast is we've seen reasonably good business investment. Our own forecast is that productivity growth will turn around, but that is a risk to the outlook. And if productivity growth continues declining, it will make it more difficult to get inflation back to target.
Thank you. So the next round of questions will go to Mark Rendell of the Globe and Mail, then we'll go to Greg Quinn of Market News, and then Craig Lord of Global. So over to you, Mark.
Thanks for taking the question, Governor. You talked today about how the inflation target is now in sight, and I'm wondering if you can explain what you mean by that, and also how it ties back to the July NPR, where you extended the timeline to hit 2% out to 2025. So I guess, how would you describe what you mean by the target being in sight, and how that fits with the timeline extension that you put in the NPR about a month and a half ago?
Well, I think that there's two parts to that phrase. The target's in sight, but we're not there yet. So the target's in sight. Look, we've come a long way. I mean, you know, last summer we were at 8% inflation. We were increasing interest rates in steps of 100 basis points and 75 basis points. We have come a long way from there. Inflation has come down significantly from 8 to a little over 3%. The economy also, it is rebalancing. You can see the adjustment in the labor market. You can see the impact of higher interest rates on household spending, particularly in the interest-sensitive items. It looks like it's starting to spread to services. So, in that sense, that's what we mean. The target's in sight. We've come a long way. The conditions are in place to bring inflation back to target. Having said that, we're not there yet. Inflation is still too high, and we are concerned that downward momentum is slowing, and those underlying inflationary pressures, they're looking stubbornly persistent. So we think the conditions are in place, but we've still got some ways to go. We've been very clear on the things we're watching. And as I've said a number of times, if we need to do more, we're prepared to do more, but we don't want to do more than necessary.
We'll now go to Greg Quinn of Market News.
Hello. The rate statement Wednesday had several references that could have perhaps fit in with the decision to hike again. Slow progress in getting inflation down, gasoline prices on the rise again, and a risk of an entrenched inflation. Was there much discussion of another hike this week?
Well, you'll receive the summary of deliberations in about 2 weeks, so you'll get a more detailed assessment. I think the clear consensus around the table, I think where members, I think what everybody could see is, since mid-July, evidence that the economy was slowing, evidence that demand and supply were coming into better balance, that evidence had become clearer. And as I just mentioned in the response to Mark's question, if you look at the labor market, we continued to see gradual adjustment in the labor market, vacancies coming down, unemployment rate ticking up. Clearly, second quarter GDP growth essentially flat. And you also, look at the components of that. I mean, yes, the weakness in second quarter GDP growth, it was magnified by, well, particularly by the forest fires that we've seen across this country. But even controlling for that, consumption weakened quite a bit, and you can see it particularly in the interest-sensitive elements of consumption, which suggests that higher interest rates are having traction, and although we are concerned about the persistence of inflationary pressures, as demand and supply come into better balance, that should relieve price pressures, and I think that was really front and center in our decision, both to keep the policy rate at 5% yesterday, and the agreement among the Governing Council that if we needed to do more, we are prepared to raise interest rates further.
Thank you. We'll go to Craig Lord of Global.
Hi. When the Bank of Canada held interest rates earlier this year, there was more explicit language about it being a conditional pause in the tightening cycle. Some economists, in hindsight, maybe said that had an effect of reigniting, some consumer spending and the housing market. Why was there no language about a conditional pause on Wednesday's announcement?
Well, I think the situation today is pretty different than the situation when we announced the conditional pause in January. I mean, you have to keep in mind, when we announced the conditional pause, we just come off a period where we had raised interest rates at the fastest pace in the Bank of Canada's history. As I just mentioned, last summer we were, doing policy increases in steps of 100, 75. We went on to, there was 50s. So, this was an unprecedentedly rapid pace. And it made sense to pause and allow that to feed through and see what the effects of that were. And we were very clear at the time. Yes, we announced we're on a conditional pause to assess whether monetary policy is sufficiently restrictive to restore price stability. And after 4 or 5 months, with an accumulation of evidence that excess demand was proving more persistent, inflationary pressures were proving more persistent, we came to the view that we hadn't done enough, and obviously we raised rates in June and July. This time, I think the message is we're going to be taking it one decision at a time. Interest rates may be sufficiently restrictive to restore price stability, but given the persistence of underlying inflation, there's a number of things we need to see before we can be more confident in that conclusion. And I think we outlined the things we're particularly watching in the press release.
Okay, we have a quick last round of questions on the phone. So we'll start with Max Sato of Mace News. Then we'll go over to Barbara Schechter of the Financial Post, and then Mary Brooke of Island Social Trends. So Max Sato, you can go ahead.
Thank you, Governor. My question is about how you're going to make sure that inflation is not going to rise again when it has actually come down to around 2%. Do you think your approach has an element of an overshoot commitment to make sure that inflation is not going to come back again? Or would it be risky to change your policy stance after confirming in the lagging indicators such as the CPI?
I had trouble catching all of your question, but I think what you were saying is, are we trying to, how are we balancing those risks? Well, first of all, let me say, our July forecast has inflation staying roughly around 3 for some time before gradually coming down to the 2% target by the middle of 2025. We'll be publishing a revised outlook inflation forecast in October. Since then, as we've highlighted, there's clear evidence that demand and supply are coming into better balance. That should help relieve inflationary pressures. On the other hand, in the short run, we know global oil prices have gone back up. That's undoubtedly going to lead to some increases in gasoline prices. So, for the next at least couple of months, you're probably going to see the headline inflation prints higher. We expect inflation should ease, but look, going forward, as I've underlined a number of times, we're going to be looking for further evidence that inflationary pressures are easing. And I think we've been pretty clear about the indicators we'll be watching to make that assessment.
We'll go to Barbara Schechter of the Financial Post.
Hello. I guess this is a good time in the call to ask about if what you think is going to come to pass comes to pass and you do get to target, what does that mean in terms of rates? Will it be just a steady hold for a while, or will things start to come down? And do you foresee it coming down in small increments like you've been going up recently, or larger chunks if things are under control like you were doing earlier on the raising side?
When the economy is in balance, when inflation is back to 2%, we do expect interest rates can come down. And given that monetary policy needs to be forward-looking, you could well start that before you're all the way there. But we're not there yet. Inflation is still too high. We are concerned about the persistence of underlying inflationary pressures. So it is too early to be talking. It's still much too early to be talking about interest rate cuts. We are really going to be looking for that evidence that inflation is coming down. And as I've said a number of times, if it becomes clear that we're not on the path to price stability, we are prepared to raise interest rates further. We don't want to do more than we have to. We know interest rate increases have hit some Canadians very hard. We know it's squeezing them. We are certainly hearing from Canadians, and we can see it in the data. We can see the impacts in the data. So we don't want to underdo it. We're committed to getting back to our 2% target, but we also don't want to over-tighten.
But as to what you just said about your latest, the 2025 sort of outlook, you're saying that you could start bringing them down before you even hit that 2%?
Look, if the conditions suggest that we don't need as restrictive monetary policy to hit the target, yes, we can lower interest rates. But I do want to underline again that we're not there yet, and it is too early to be talking about interest rate cuts. We are still assessing whether monetary policy is restrictive enough to get us back to the target.
Okay, thank you.
Okay, we're quite over time, so we'll wrap up with Mary Brooke of Island Social Trends. You can go ahead, Mary. Mary, are you on the line?
Yes. Can you hear me now?
We can
Not-
hear you not very, very strongly, though.
Oh, okay. You have response to the political commentary from the premier.
We can't really hear you.
Sorry.
Maybe you can send quickly your question in the chat and I can read it out for you.
All right, when you go to our next question and come back.
Okay, we will go quickly to one. We'll just see if we can hear from Mary quickly. Okay, I think we will stop here, given that we are over time. So thank you, everyone, for participating.
Thanks very much.